Follow the money. It always leads somewhere they didn't want you to look.
In March 2023, Silicon Valley Bank, once the 16th largest bank in the United States, collapsed in a matter of just 48 hours. This rapid disintegration marked the second largest bank failure in US history, surpassed only by the collapse of Washington Mutual in 2008. With assets totaling approximately $209 billion and deposits of around $175 billion at the end of 2022, the bank's sudden downfall sent shockwaves through the financial world. Silicon Valley Bank, often abbreviated as SVB, had built its reputation as a pivotal financial institution for the technology sector. It was a specialized bank, focusing heavily on venture capital-backed startups and established technology firms. This niche market, while lucrative during periods of economic growth, left the bank vulnerable to market shifts, as it was heavily reliant on the tech industry's performance. The bank's troubles began to escalate in early 2023, as interest rates rose sharply. The Federal Reserve had increased rates to combat high inflation, which had reached levels not seen in decades. This increase in interest rates led to a significant change in the economic landscape, particularly affecting sectors with high exposure to interest rate fluctuations. SVB's portfolio, heavily invested in long-term government bonds, was hit hard as bond prices fell. These bonds, once a stable and reliable investment, turned into liabilities as their market value dropped and SVB faced a liquidity crunch. On March 8, 2023, SVB made a public announcement that it had sold a large portion of its securities at a loss and was seeking to raise over $2 billion to shore up its balance sheet. This triggered panic among its clients, many of whom were venture capitalists and startup companies, leading to a classic bank run. Within 48 hours, customers attempted to withdraw $42 billion, roughly a quarter of the bank's total deposits. The speed and scale of the withdrawals overwhelmed SVB's ability to meet its obligations, leading to its collapse. Regulators swiftly intervened. The Federal Deposit Insurance Corporation, the FDIC, took control of SVB on March 10, 2023. This move was aimed at protecting depositors, preserving the bank's assets, and maintaining stability within the financial system. The FDIC established a new entity, the Deposit Insurance National Bank of Santa Clara, to manage and eventually sell off SVB's assets. The collapse of Silicon Valley Bank raised numerous questions about risk management and regulatory oversight within the banking sector. It also highlighted the potential systemic risks posed by banks with concentrated exposure to particular industries, in this case, the technology sector. As the repercussions of SVB's failure continue to unfold, one must consider: how can financial institutions better insulate themselves against sector-specific vulnerabilities? The fall of Silicon Valley Bank was not an isolated event. It occurred within a broader context of financial instability and regulatory scrutiny. The collapse prompted immediate and widespread reactions, both within the United States and internationally. Investors and analysts quickly drew parallels to the 2008 financial crisis, when the failure of major financial institutions had far-reaching consequences. In the days following SVB's collapse, stock markets reacted with volatility, particularly among financial stocks. The fear of contagion, where the failure of one bank could lead to a loss of confidence in others, was palpable. Banks with similar business models or exposure to the technology sector faced increased scrutiny from investors and regulators alike. Signature Bank, another financial institution with significant exposure to cryptocurrency and technology investments, also experienced heightened market pressure, leading to concerns about its financial health. The US government and the Federal Reserve moved rapidly to reassure the public and stabilize the financial system. The Federal Reserve announced measures to provide additional liquidity to banks facing similar pressures, effectively creating a backstop to prevent further bank runs. This action aimed to restore confidence and demonstrate the government's commitment to maintaining the stability of the banking sector. Internationally, SVB's collapse sparked discussions among global financial regulators. In Europe, the European Central Bank reviewed its own regulatory frameworks, assessing the resilience of banks within its jurisdiction. European banks, while generally less exposed to the technology sector compared to their US counterparts, still faced questions about their risk management practices. In Asia, markets reacted with caution. Central banks in countries like Japan and South Korea engaged in consultations to assess potential impacts on their financial systems. These discussions underscored the interconnectedness of global finance and the ripple effects that can result from even a single bank's failure. The collapse also reignited debates about the adequacy of existing regulatory frameworks. Critics argued that the regulatory environment had failed to keep pace with the evolution of the banking industry, particularly with the rise of specialized banks like SVB. There were calls for increased transparency and more stringent oversight, especially for banks with concentrated sectoral exposure. In the aftermath, the focus shifted to understanding the lessons that could be learned. Analysts examined SVB's risk management strategies, questioning whether the bank had underestimated the risks associated with its concentrated investment portfolio. They also scrutinized the role of the Federal Reserve's monetary policy in exacerbating the bank's vulnerabilities. As financial institutions and regulators around the world grapple with these questions, the case of Silicon Valley Bank serves as a stark reminder of the challenges inherent in managing sector-specific risks within a rapidly changing economic landscape. How will the global financial system adapt to prevent similar occurrences in the future? The collapse of Silicon Valley Bank has catalyzed a renewed focus on the intricacies of risk management within financial institutions. As the dust settles, stakeholders across the spectrum are grappling with the implications of this significant event, and industry analysts are now tasked with dissecting the factors that contributed to SVB's rapid downfall and the broader lessons that can be applied to prevent similar occurrences. One critical aspect under scrutiny is the role of interest rate exposure in SVB's collapse. The bank's heavy investment in long-term government bonds, once deemed a conservative strategy, became problematic as interest rates rose. This shift in monetary policy by the Federal Reserve aimed at curbing inflation revealed the vulnerabilities inherent in relying heavily on fixed-income securities during periods of economic fluctuation. Financial analysts are now questioning the extent to which other banks may be similarly exposed and whether current risk assessment models adequately account for such rapid changes in the economic environment. Moreover, the SVB case highlights the challenges faced by niche banks with concentrated sectoral exposure. While specialization can provide a competitive advantage during times of sectoral growth, it also poses significant risks when market conditions shift. The tech industry, a primary client base for SVB, experienced its own set of challenges as the economic climate changed, impacting the bank's stability. This has prompted a broader discussion about diversification strategies and the need for banks to balance specialization with broader exposure to mitigate potential risks. Regulatory bodies are also re-evaluating their approaches in light of SVB's collapse. The rapid intervention by the FDIC and the Federal Reserve demonstrated a commitment to maintaining financial stability. Yet it also underscored the importance of proactive regulatory frameworks. Questions are being raised about whether existing regulations are sufficiently robust to address the complexities of modern banking, particularly for institutions with unique business models like SVB. Internationally, the reverberations of SVB's collapse have prompted global financial regulators to examine their own systems. The interconnected nature of the global financial system means that vulnerabilities in one region can have far-reaching impacts. This has led to calls for greater international cooperation and information sharing among regulatory bodies to ensure that systemic risks are identified and managed effectively. As the financial world continues to analyze the collapse of Silicon Valley Bank, one question remains paramount. What steps can be taken to enhance the resilience of financial institutions in an increasingly complex and interconnected global economy? The answers to this question will shape the future of banking regulation and risk management, influencing the strategies of financial institutions and the policies of regulators worldwide. In the wake of SVB's downfall, the challenge lies in balancing innovation with prudence, ensuring that banks are equipped to navigate the uncertainties of a dynamic economic landscape.